Case in point, we have a swing low, a single candle that has a higher low to the right and a higher low to the left. One single candle there, that swing low, is going to be seen as a short-term swing low where sell stops are sitting right below that because the market's rallied up, consolidated, rallied again, and when it's up in here, all in this consolidation, those that bought down here or even over here, they have their stop loss trailed right below that low. And the market drops down to take those participants out and then rallies. Why is it going down there? To accumulate sell stops. Why are they attacking the sell stops? Because this is attacking participants that are willing to sell at a lower price. Lower than what? When it was up here. Institutional traders will not buy up here. They're going to wait for it to drop down to attack a very deep discounted price and pool of liquidity of sellers that want to sell at a cheap price because they trail their stop loss up there. So these sell stops flood the market with sell orders and smart money buys them at the market. So it goes right in here and buys them. So this is called pairing of orders. The market hits this and then price rallies. Now this is that same swing low, but I'm drawing your attention to these consecutive down close candles because this is a bullish order block, the high to the opening price. Now why not the entire range like a supply and demand zone would be? Well, this is not supply and demand. So it's the high down to the opening price, extend that out in time, and the market drops down into that. That's a bullish order block, and it's taking out sell stops. So a high probability order block is when it takes out stops and returns down to the order block itself. The underlying pinnings of the market is it's bullish, so therefore down close candles that have a market move away from it and has a swing low just above it, like we do here. That's a confluence of specific things that make it high probability for the order block. The order block is the consecutive down close candles. All three of them make up the order block, but the sensitive price point is the high and the opening. So you can be a buyer at this high or at the opening price. The easiest one is using the high and allowing your stop to absorb any adverse price movement against you that would, if it was going to go back into, say, the opening price, you have to consider that when you're placing your stop. You could be buying at the high and use the low of all the consecutive down close candles. Your stop loss needs to be just below that. Does the market stay there very long once it trades into it? No. Leaves it, consolidates, rallies again, comes back down into another order block here. Trades lower, accumulates and rallies again, trades one more time, retracement, and then blasts off and attacks all the buy stops that were resting above these clean highs. Notice also, before the market starts to rally, it generally takes out some short-term swing low. This low took out this swing low. This low took out this swing low. This low took out this swing low. Each time there's a dynamic rally higher. This swing low was taken out by this swing low, and it rallies higher. This swing low is taken out by that swing low. Not by much, but it's all it takes. And then it starts to move higher. So when there's a run on liquidity that's opposed to the underlying direction, in other words, if we're bullish on a market like this, get comfortable with the market reaching underneath lows and stop thinking that it's going to be breaking down entirely or reversing. Most of the time, you're going to find that it's taking those sell stops out and absorbing them to offer smart money buying opportunities at deep discount prices. Finally, we're looking at price on Monday and today, Tuesday. And I want you to notice how the market does what? It creates the low in London and then a continuation in the New York session. On Tuesday, it creates the low of the day and a continuation in New York, and it rallies up. It's consolidating in here. And where does the liquidity reside? Again, this blue line is that weekly line I drew out that was a clean level where the buy stops are. So the market's most likely going to draw up into that 139 big figure, 139.10, and the institutional level, 139.20, could potentially be traded to as well to make sure it really sweeps out all those buy stops. Now, what's the vested interest for the market to send price that high? Because smart money has bought down here, they bought down here, and they bought down here. Where do they want to get out at? At a high price. Who's willing to buy it from them at a high price? The buy stops resting just above that level here I noted on the weekly chart.